a lot of people are familiar with the traditional HELOC. Are you familiar
Hmm.
with that? And then are you familiar with the last 6 or 7 years, they've updated to Home Equity Agreement, which is like a loan version of the HELOC. So what we've done is what we've done is try to take it out of the financial industry and put it back into the real estate industry, and more so actually bringing and bridging the contractors into self-accountable work and into the equation, instead of just relying on the homeowner, having cash on their hand and going to try to manage any contractor. So we reworked the whole situation, not just from trying to get cash out of your equity of your home, but aligning and structuring it so we're making sure that homeowners are using it responsibly. And the only way to do that is to take the cash out of the equation and pay contractors directly with equity. So that's what a home equity invoice agreement does. It takes the contractors, so whatever your plumbing invoice is right now, it converts
Hmm.
that into your property's equity. Similar to a home equity agreement, but you're in full control of it. So you're not locked in for the full whatever they gave you quote wise or whatever they force you to get in structure wise, so that the bank and the third party make sure that they, capitalize on all of them. They're deploying capital as much as their other financial products. We don't we're not a financial institution. We just provide this document, the same document that HELOC banks and home equity agreement banks use. We give that document to homeowners and contractors, so you guys can now unlock your own equity and pay and use your own equity for construction or any kind of value add to the property. You can use it for permitting or subdividing land too. But for the basic stuff, it's, big renovations, stuff that's going to add value to the property is the main thing. But for like your situation, emergency situations, you can still capitalize and use your equity that's in there without adding value to the actual property. And then you control when you set the actual payment with your contractor of if he wants to get paid off in 6 months to a year. Usually they want to hold on to it for at least that year mark because then it turns into capital gains tax for them. So whatever you're paying them, they're saving 17% on their invoice just by holding off and waiting to pay them off on that year mark. If not, it's totally fine. You can pay them off in a month, 2 months. It's all negotiable and in your control with your contractor. I mean, it helps you as the homeowner to position that you're making sure that you're attracting self-accountable contractors because they're right now putting, their cash and capital work into your property's equity and waiting for you to pay them back, without relying on your credit because they're already secured. The state and everything that we have to go through contractors. I'm a third generation contractor. We're already getting charged, 25% extra on the tax side. You know what I mean? And that's why we have to inflate the cash invoices. So even that $18,000, if you guys are good reworking that payment on your accounting, you can save already remaining 20% on that $18,000, which is what, 1,600 bucks already, just
Hmm.
by routing it through this document. Because the way it works is you're paying them in equity, and then if maybe you're paying, the cash disbursements based on that equity, you're giving him capital disbursements based on an equity value that doesn't get settled until you pay off that equity value in total. So it alleviates it as a cash transaction, and it's a joint venture deed of trust to where it's not a sales cash transaction, it's an equity transaction, where you don't have to pay him an ordinary income. It's capital gains that he's attaching himself to that property. Does that make sense? I don't know how familiar. So it depends what state you're in. On that $18,000, someone's probably paying sales tax, and then some states like Hawaii, there's another two taxes on that for construction. So even that, you can wipe off just the sales tax on that, depending on what state you're in if you have sales tax on that. So it helps alleviate all those taxes at minimum, and then it gives you and the contractor some kind of actual flexible payment. So like the 50% that you just put down, he may want to actually hold the other 50% and not have you pay that off again until the year mark so that he can collect that extra 17% and just keep you at still the 18,000, but he's pushing that extra 9,000 to wait for the year mark. And then he saves 70% on the full 18,000 because he didn't pay it off until the year. We're getting around to the service company businesses because a lot of them are doing the service model right now to where instead of having big chunks like that $18,000, they're operating on a service subscription program. And then they have different maintenance or different repair requests that they cover during that. we're starting at the lower end individuals and then getting more to the corporates, get them to change and start using it. Just want to send over whoever is your contact, whoever you're paying the billing wise for that rotor company or that franchise that's in your area, because it is still a franchise. So he still has some kind of usability. If you want to just shoot him over the contact, we'll reach out to them and we can negotiate with them on your behalf. Normally we have liaisons, and that's what our company does. We license liaisons, people that have all this knowledge and it makes sense to go help homeowners and contractors know that this is available to use. And then obviously you just got to be stupid not to use it. You know what I mean? Because you just save 25% just on using normal processes of payment. And then you can obviously maximize it by different strategies of that payment structure. But that's normally what we do. We don't have many liaisons right now, so I'm glad to hop on and help those contractors out to get them on a smarter payment cycle for both of them and their clients. So yeah, your current situation might not help, but if for the future stuff, or if you want to do renovations on properties before you sell or anything, it's great to have there. And then there already are some contractors. I don't know if we have plumbers. I don't know if you've looked through our website. We've list contractors on our website that are already doing this payment structure.
Okay.
I think some are in Phoenix, Arizona already. I just don't know that they were doing plumbing or not. I'm actually at
Kind of got.
the Phoenix airport right now. So yeah, I go to
Uh,
all these network events and businesses and stuff, try to get in to, starting from like corporate down
uh-huh.
level to get them pushing it. But, it's a harder sell to get them to change their current operations. Yeah, we're always looking to just to get it out there, especially because podcasters right now are charging $25,000 just for one podcast. Being persistent, like, look, hey, this isn't going away, and you're going to be competition wise now with everyone else. It's not just a hidden secret anymore. This is getting pushed out everywhere. We have a free course it's an 8 hour plus course, break it down to different sections, each about an hour or so long. You can grab this contract for $1, and that's mainly everything proprietary that we built into this is that contract. We want contractors and homeowners to use that as much as possible. So we would give it away for free. Like $1 at least gives us some kind of tracking to protect the
Mhm.
proprietary structure of it. Yeah, you can grab it now for $1, and then if you ever need to use it again for any other contractor and you don't know how to pitch them or anything or educate them on how to use it, you can just find a liaison or just send them over to our website, and then we'll help bridge that gap for them also, and just show both sides like, hey, it's both beneficial for both sides. There's no ifs, ands, or buts about working against each other. It's actually working
Mhm.
together and just finalizing, hey, what the value is on that. It's based on the structure of how you set it up. So there's two ways you can pay them: a monthly disbursement, which is they just agree on the monthly payment, or a scope of work, which is, hey, they have a full scope of work of a renovation, and per like different phases, you can pay them out on that scope of work once they complete those scopes of work. Or obviously the best case scenario is they don't get paid so the house sells, because it's a deed is what the document is. So it gets recorded with all your other deeds on your property. The education that we provide, because deeds, they don't have the conventional mortgage deeds are 30 years, which is a predatory debt structure anyways behind those 30 years. That's what we look at. Any debt structure with interest, it's just predatory. Like when shit hits the fan, and a lot of people it's hitting the fan right now, like
Yeah.
you'll find out, oh, this is what this is. And this is why
Yeah.
there's so much regulation around it, because it's very easy to become predatory on it. But this is set where you control it. So you can pay it off in a month, 2 months, 3 months,
Right.
4 years, 5 years. The contractor just knows that he's secured as much as the bank and lender are. So they know if they set up that payment structure for 3 months, a year, they don't have to rely on your credit. They don't have to
Right.
rely on your finances. They're relying on the actual real estate and asset. So it alleviates even having to have a financial kind of underwriting process for this. It's all just based on the asset, and the contractors. Once we educate them, like, look, we give you the same payment security as insurance companies, banks, and lenders. Like, it's provided to you now on this structure for you to use. And that's why it's very easy to get these contractors to do this, because they're already used to flexible payment options. Not obviously Mr. Rotor and stuff. It's more we got to get in there and get them a set plan for them to push out at market for their company. But we're
Hmm.
more the smaller guys that have more flexibility, which a lot of them do. It gives you, the homeowner, and them the flexibility to discuss, hey, 1 month, 3 months, 4 years, 5 years, 30 years. It's up to your control and what they have. So that's the beauty of this. We're getting away from the predatory financial debt structures because right now there's a lot of upside down notes, meaning that there's more debt than the home's valued at, because
Mhm.
that's the way it's working right now because of the correction, and we can't push home prices up to keep up with that debt. We said, hey, let's take out the debt structures, and it's not a financial product where you have to sit down and do a whole bunch of calculations and figure out time spans and stuff. No, it's a simple, hey, if I got 10%, if my $10,000 of a $100,000 property is 10%, well, hey, I'm now giving 10% to that contractor. Now the contractor is banking on obviously the tax savings immediately, and then the secondary appreciation, which is all right. Well, if I hold it for a year, averagely the market appreciates 5% until you're in a 2018 correction, and then it's changing. And then they want to do shorter term instead of longer term, or they want to do longer term to wait out that period. So it gives that flexibility. They're banking on just the appreciation, not the interest, which the appreciation side, just like the home equity agreement guys do, they're just banking on the appreciation, but they lock you in to make sure they are secured for that appreciation so that you
Mhm.
can't sell and undercut them. You still protect the contractors where you can't undercut them and oversell them. And the main thing is that they're automatically guaranteed the material and labor price, which they have to disclose to you. Right now, Mr. Roder's not going to tell you the material labor price. And when they do,
Right.
they're going to automatically mark it up and tell you the markup price instead of the true
Right.
price. And that's what
Right.
we're breaking that out, saying, hey,
Mhm.
well, if you want equity contractors, you have to show what your actual material and labor is, because that's their floor price. So if even the house went to foreclosure and the homeowner never paid them, they're guaranteed to get paid that floor price of that property or that material and labor that they put into that property. It's just an extra. They technically, contractors already have material liens. Anytime you sign any invoice, it's a material lien that they can do. It's just a judicial long process that they have to take to reclaim that if they don't get paid, which
Right.
the headaches they don't want to deal with. Well, now we've added the deed part of it. It's a non-judicial process to reclaim any agreed amount that was agreed on and actually
Mhm.
put in on the property. And more than just put in on the property, the true value that was put on the property, the material and labor, separate from the business quality amount. So we're actually standardizing construction pricing throughout
Yeah.
the nation right now, because
It.
California it's 300,000 for a house to build, but you can get the same house built for 100,000 in North Carolina. We've been building out the structure for the last 10 months and just finally been marketing it for the last 3 months. We're all performance based, so like, and that's why we have an affiliation license also, for just the media guys, the marketing side of every business, just the marketing industry in general, and mainly just a rebuttal every time I get a marketer coming up to me asking for their service. I just hit them with, look, this whole contract is performance based. Like no one gets paid until everything works out. The same thing, our whole business values is structured. Like, look, if we're going to do any kind of business transaction here, we're all performance based. Like, this is what we provide, and this is what you're claiming that you provide. Well, I'm not paying an upfront fee until after it happens on our side to show them that we're legit. Our
Mhm.
affiliation license, we give 50% revenue share on the licensing of the other liaisons. So our liaison license for me to license other people to go help other people do this. Traditional fix and flippers or real estate investors can now do this instead of having a bank and lender purchase a property and then control the renovations on it. No, you can just work out the deal, control the renovations securely with this now instead of having to purchase the whole property. Now you can actually help homeowners selling instead of having to negotiate their minimum deal of their as is property. Our liaison license is 14,000 normally for people. And then if you already have a state license, like a realtor state or agent license, broker license, loan broker license, lender license, a financial license, any state license that's regulated and tested, it's half off. So it's 7,000, and our affiliates get 50% of those two situations. Or for the affiliates, unfortunately, we also do license liaisons for free. We have a wait list for people. If we already have a homeowner contract that need help, and we have a liaison on the wait list that's in the area that can help them, we just license them for free and have them go help them. The licensing and the money and stuff, it's not a state license. We've made sure we've made this movability wise and usability wise to not have to deal with that.
Mhm.
If you are using it in a tradition that requires a state license, like if I'm lending someone else's money to the contractor for the homeowner's behalf, then I have to have my loan broker license with my. We have our first apprentice book is pretty much just educating people on what wealth really is. Just the three pillars: appreciation, positive appreciation, and tax incentives. Not cash. Cash is none of
Okay.
those.
Yeah.